Welcome to the Explainer. Today, we're going to tackle India's Goods and Services Tax Act of 2017. Our goal is to break this really complex law down into a simple step-by-step journey that any business owner can actually follow. So you might be asking, why was this change such a big deal? Well, before July 1st, 2017, the tax system was honestly a tangled mess. You had all these different state and central taxes, think VAT, service tax, excise duty. It was complicated. And then the GST Act comes in and just sweeps all of that away, creating one single unified system for the entire country. To really get a handle on this, we're going to walk through the process just like a new business owner would. We'll cover 6 key stages, starting with the absolute basics of what GST even is, and we'll go all the way to what happens if, you happen to miss a deadline. All right, let's dive right into Section 1, what is the GST? Seriously, getting this foundation right is the key to making sense of everything else that follows. So, first things first, who does this law even apply to? In the world of GST, they call this a taxable person, and all that really means is any business or individual who's either already signed up for GST or is legally supposed to be. Simple as that. And just as important as knowing what is taxed, you've got to know what isn't. The law has a special term for this, an exempt supply. These are just very specific goods or services that either have a zero tax rate or are just completely excused from GST altogether. Okay, now we're getting to the first real practical step on our journey, getting registered. We're also going to talk about the idea of a supply, which is, without a doubt, the most important concept because it's the thing that actually triggers the tax. So for any business owner out there, this is probably the very first question that pops into your head. Do I legally have to register for GST? And let me tell you, this isn't really a choice. The law sets very clear rules. For most folks, the answer comes down to your annual turnover. The law sets different limits. 40 lakh rupees if your business mainly supplies goods, and a lower threshold of 20 lakh rupees if you're focused on providing services. But, and this is a big but, you gotta watch out. There are some businesses that must register no matter what their turnover is. This is a must for anyone selling goods across state lines, for most e-commerce sellers, and for what the law calls casual taxable persons. You can think of that as someone setting up, say, a temporary pop-up shop in another state. Now, once you're in the system, the magic word is supply. The main thing to get here is just how incredibly broad this definition is. We're not just talking about a sale. It covers transfers, barters, exchanges, leases. Basically any kind of commercial transaction you can think of. And this brings up a really smart distinction the law makes when you bundle products together. If the items are naturally bundled, like a hotel room that comes with breakfast, it's called a composite supply, and it gets taxed at the rate of the main item. But if you just bundle a bunch of unrelated things together, like a gift basket with toys and chocolates, that becomes a mixed supply, and then it has to be taxed at whatever the highest rate is for any single item in that bundle. Okay, so you're registered, you've made a supply. Now for the million-dollar question. How in the world do you figure out exactly how much tax you owe? Now, here's the thing you absolutely have to remember. GST isn't just calculated on the base price. It's charged on the total transaction value. So what that means is you start with a price, and then you add any of those extra costs that get passed on to the customer, like, say, packing fees, to get your final taxable amount. And this is where we get to what is, honestly, one of the absolute game changers of the entire GST system. Input tax credit, or as everyone calls it, ITC. You see, the entire system was built to fix this huge problem that plagued the old tax system. How do you stop that cascading effect where you're just paying tax on top of tax on top of tax at every step of the supply chain? And the answer? It's that beautiful thing called input tax credit. The idea is actually pretty simple. It lets you subtract the GST you already paid on your business purchases from the GST you collected on your sales. You only end up paying the net difference to the government. It's brilliant. Now, hold on. It's not a complete free-for-all. The law is super specific that you can't claim this credit on just anything. There's a whole list of what they call blocked credits, and this includes things bought for personal use, most company cars, and food and beverage expenses, unless, of course, that's your actual business. So claiming that credit feels great, right? But with great power comes great responsibility. The whole system really relies on businesses like yours staying on top of all the compliance obligations. So let's break down that core monthly filing process. It really boils down to 3 key forms. First, you declare all of your sales in a form called GSTR1. Then, based on that data, the system automatically figures out your eligible credits in GSTR 2B. And finally, you just confirm all the details and pay any tax that's due in your summary return, which is GSTR 3B. Okay, but let's be real. Mistakes happen. Deadlines get missed sometimes. So what happens then? Well, the law has a pretty clear framework for enforcement and penalties. When it comes to paying late, the rule is crystal clear. Section 50 of the Act lays out a standard interest rate which is charged at 18% per year on the amount of tax that was paid late. But for bigger problems, the government looks at one thing above all else: your intent. Section 73 is for genuine, honest mistakes. But Section 74? That's reserved for cases of deliberate fraud, for hiding facts, or for willful misstatements. And as you can imagine, it comes with much, much harsher consequences. You know, when you boil it all down, this whole journey we've been on is perfectly summed up by this one statement. The Act really is the complete rulebook, defining the how, the when, and the how much for every single part of the GST process. And that brings our explainer to a close. But it leaves you with a really important question to think about. Now that you've seen the whole map of the GST journey, which stop on that map is the most critical for your business? Is it calculating the value correctly, claiming all your credits, or just mastering that monthly filing process? That's the key question to take away.